We launched something pretty cool. Still under construction. The color coding needs work right now, but we launched something that a lot of our users requested, which is some top setups focused, so the top setups algorithm, right? The generic one or the main one considers sentiment, technical, and sentiment. Sentiment, technicals, and fundamentals. It combines all three to give you a total kind of summary score. But some people prefer just looking at economic data. Other people prefer just sentiment data. And what's exciting is that we do, in fact, have the sentiment one coming too, but right now we already have the economic focused top setups scoring. This will show you when we look at only economic data, the scoring algorithm that the Edge Finder is using. It just isolates the Edge Finder's eco score. So that was a request by a number of people who wanted more kind of focused in top setups ideas. And I think it's really an exciting one. So you can currently see the most bearish and most bullish economic readings within the Edge Finder. And then of course I still, I'm sticking to my bread and butter, which is I want to look at all three, but some people prefer to look at only sentiment. They prefer to look at only economic. So we've built some screens that we're going to implement there. Bought the Edge Finder last night with a 45% discount. Awesome. Congrats on that. Bashi, is there a payment plan option for the 45% off? For you, we'll make an exception. If you send us a direct message right now, someone from our team will try and sort it out for you. Like I said, shoot us a DM on our website, a1trading.com, speak with a support rep. They may be able to help you sort out something that works best for you. Okay, so let's talk markets. Stocks are all over the place. Indices wobbly at best as we sit here at the lows. You had a nice bounce back yesterday. Yesterday, I bought a stock that I haven't bought in so long. You ready for it? Anybody have a guess? What stock did I buy yesterday? What stock? Starts with an M. Starts with an M. It's Meta. I bought Meta stock yesterday. One of my favorite long-term companies is Meta. Why? Meta is really cool for a main reason, which is Meta, of all of the companies out there, I can't think of a company that is better leveraging AI today. Not in the future. Tesla, for example, is a speculative idea. Their idea is like, in the future, they're going to seriously leverage AI. Are they using it today? Sure. But to me, Meta is massively using AI right now. Have you ever noticed when you go on Facebook or Instagram or these social media sites, how smart they are at keeping you on the platform? They're watching everything you do, and that is AI, right? AI, they are implementing a ton of artificial intelligence into making their platforms more sticky, keeping all of us glued to our screen so they can sell more advertising. Look, Instagram, Facebook, all the doom scrolling that we all do, right? That's AI being leveraged today to make money, right? So Meta is a company I love. And at the discount that we're getting, right? Yesterday, I bought it at about a 23% discount off of the all-time highs. So I'm slightly in profit on my position, but this is a longer-term position trade for me. And just a stock that I've owned off and on for years. I actually bought it. You want to hear a big oof from me? I bought Meta down here. I'm not even kidding. I think I might have got it at like $89 a share. It was like right down at the lows. Like I bought this thing. I think I bought some and then I bought more after this big tank. I bought like the low on Meta. Back then it was Facebook. And then you know what I did? I sold out of it. I can't remember when I sold it, but it was way too early. Way too early. And then it proceeded to, from the lows, you ready for this? This stock, 7x'd. That's crazy, right? So I sold way too soon on the stock on this stock in the past. But it's a company that I love, and making a bet on the Zuck, if you will. Anyways, NASDAQ still looking pretty ugly. And this is a test here today. But really, I think all eyes are focused on tomorrow's tariff news. You've got a lot of uncertainty in this market. So what we saw here is a push below the lows here yesterday. But before we can get too bearish on this, I mean, that was a sharp reaction from the bulls. Bulls scooped yesterday's low really aggressively. We got to give it to them, right? The NASDAQ bulls really came in strong yesterday. That may not look like much, but this guy's at one point was almost a 3% rally intraday. This market is so volatile. To get these kinds of moves, 3% down, and then another, massive move lower, and then a rally through the day. I mean, these are some volatile times that we are living in. Certainly, there is plenty of opportunity if you are willing to be patient, look for proper setups. I still think that the NASDAQ and S&P are in the process of bottoming. We may see fresh lows here before that is in, but I do think that there is a good chance that we are reaching the lows of this move. We launched the Edge Finder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the Edge Finder is producing now. The Edge Finder has helped traders go from beginner to pro in terms of the fundamentals, and has helped many traders go from unprofitable to finding the missing pieces in the name Edge Finder. So if you're not already using the Edge Finder, let me tell you about the biggest discount that we offer all year long, starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the Edge Finder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the Edge Finder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the Edge Finder at the super discounted prices. Thanks for watching. And now back to the show. The put call ratio still at very high extreme levels. People really concerned about the NASDAQ, about the S&P, about stocks in general. Why would we buy stocks right now when we can get them much cheaper? That's the mentality of a lot of people out there. And a lot of people are buying puts. Yesterday, if you bought puts, it was, we literally called that on stream. Ivan, actually, who was in the chat, am I still correct about the NASDAQ? Let's hope, man. Let's hope. We had a good start, good bounce. Like to the minute, Ivan hopped on the stream. And I don't know, maybe Ivan is a good luck charm, but we started bottoming out. We discussed on stream how a lot of people are going to buy puts today. That's exactly what people did. And those puts are already probably getting hurt. If you bought like 3 days out puts or 1 week till expiration puts, I mean, this is a story as old as market time. People buy puts at the worst possible time. We saw the big spike in put demand right here, right? Puts are bearish bets, right? People made huge bearish bets right there when that market just popped just a little bit. Minus 100% for a lot of options out there, right? A lot of options lost complete amounts of their value, right? 100% losses on their puts if you bought puts at the worst possible time. So I think people are doing that right now. And I'll continue to say that with such an elevated put to call ratio, the premium on puts is very high. As an option seller, I love this type of environment because I can sell puts, sell calls, and make a lot of income just off of being the market maker, right? The market maker is selling puts, selling calls, and collecting income just from people making big bets on where they let everybody else play the casino. That's the market maker's model. They basically just say, if you want to make a huge bet that the market's going to crash, go for it. We'll sell you that option. If you want to make a giant bet that the market's going to rip here, we'll sell you that option. And most of the time, the market maker makes money. So we've got, in just a little bit here, some PMI data coming out. 10 o'clock, that's 30 minutes. We have ISM manufacturing PMI and JOLTS job openings. Both of these are potentially pretty market moving. We definitely do not want to miss this. So we're going to pay attention to the ISM manufacturing PMIs. Let's just take a look at what we're looking at here for a forecast. We are expecting a contraction in manufacturing PMIs. Under 50 is considered contraction. Over 50 is considered expansion, okay? We are expecting a slight contraction in sentiment about forward-looking indicators of the economy. PMIs are forward-looking, right? Many people love to say, oh, so-and-so indicators are lagging, fundamentals are lagging, price action is the best. Cool thing about PMI is that PMI data asks notable people in the economy what they see coming in the future within their respective industries. So think about where, let's say that you're like a manager at a grocery store, right? Or let's say even higher than that. Like, let's say that you manage a chain of grocery stores in the southeast part of the United States. Just an example, right? You manage a bunch of grocery stores. That person within the company has a lot of eyes on, a lot of vision, a lot of Eagles level vision of what is coming for the grocery store company, right? They can see orders coming in. They can see floor traffic in the grocery stores. They can see, popular products, things that are popping off. They can see if they need to be hiring more people or letting people go, right? Key people in the economy hold a key to what the future is looking like. And so PMI data is really key. It asks those people, are you planning on hiring more? Are orders looking solid? Are they looking, weak? So this is really important data. It's forward looking. So the PMI data comes out in just about 30 minutes. And this is for the manufacturing sector of the economy, right? So manufacturing is a smaller part of the US economy than services, but still an important piece. So we'll see what that data brings us. We'll also get JOLTS job openings, right? Job openings postings are really important. If they're strong, lots of demand for hiring, that's a solid economy look. And if it's weak, if it's low levels of job openings, we'd consider that a weaker jobs market. Let's take a look while we're just on the subject of the JOLTS job openings. We can take a look at our job market data and go job openings US. So what I'm going to do here is I'm actually going to expand my search back for the last 3 years to give us some context. You can see that JOLTS job openings over the last 3-year period have been declining. You can attribute this largely to, I would say, higher interest rates. With money being a little bit more expensive to borrow, that impacts a lot of people. It impacts the consumer. It impacts businesses who are choosing to hire. So we have seen a continued overall decline in job openings, but this is not at critical levels. Let me be clear. A lot of people are like, oh, the labor market is so bad out there. It's really not in comparison to history. Okay. So we are still not quite back to pre-pandemic levels of hiring, right? We had a huge burst with interest rates going to rock bottom, right? Tons of hiring flew out in 2021, and then we started to decline. And we've been on a decline for a number of years now. We're headed back, it seems like, towards that pre-pandemic zone. And then if we take a look at the unemployment rate, this is where I also want to show you something that's pretty important. You might say, well, again, sometimes you hear people saying, oh, the job market is so bad right now. It's really not bad in comparison to historical levels, right? I'm not saying it's easy out there. We got high prices still, and I'm not saying it's easy at all. I'm just saying that in terms of what the Fed looks at for intensive purposes of this live stream, when we're talking markets, right? Unemployment rate can go much, much higher before it is considered historically problematic. 5.7%, to my knowledge, is the average unemployment rate over the long term in the United States. So where we are at with around 4% unemployment rate is really not so bad, right? We've been at a low unemployment rate through 2022, 2023, and still holding on to that low unemployment rate. The concern for many people is that unemployment rate is going to rise dramatically with all of the uncertainties around tariffs. People are worried about growth, etc. Again, this is where I say, when I talk about this stuff, there's a lot of concerns around tariffs, but right now they're just that. They're concerns. They're not certainties. We haven't seen it, I would argue, in a wide span within the economic data. Now, if unemployment rate starts to rise, again, that would be the hard data meeting the concerns. If you take a look at markets recently, right, there's been a lot of fear, a lot of people selling stocks, a lot of people, buying gold, right, running to safe havens. The point that I'm getting at with that is that unemployment rate comes out on Friday. And so the question is, does the rumor of slowing growth and concerns around tariffs and the consumer potentially freaking out and not spending as much, and does that actually materialize in the labor data that comes out on Friday? That's really what's going to be big. I mean, if you get an uptick in unemployment rate, gold can fly. That's, kind of gold's sweet spot. As people get worried about the economy, they get worried that, the Fed may need to cut interest rates to save the day, and people lose faith in the dollar, and they say, well, you know what? We need to rush to gold. And that's been the theme here, right? Gold has been going up. I mean, this has been a phenomenal trend for the gold bulls out there. Metals in general, gold is holding up a lot better than silver. Been a little bit frustrated with my silver position here. I'm still in the trade. Entered back here, nice push, broke through those levels, trailed my stop loss below this low, and yesterday we intraday retested that area, bounced back, and now it seems like we're kind of just chopping back around. I have my stop loss below this level of support, so if we fail here, I'm going to go ahead and take a profit on this move. But if we can kind of get some follow through here, if we can get some bullish pressure on metals, I'm looking to see if silver can also continue its uptrend. If it doesn't, then we'll just take profits at this breakdown. So, like I said, I like gold. It's a top setup within the Edge Finder still. Actually, is it? What happened? Where did gold go? Did I miss something? COT data. Seasonality, bearish. That's gotta be a mistake, right? Do we have an error on the gold? Yeah, we totally do. Guys, I'm gonna get that fixed right now because that is wrong. Seasonality on gold is incorrect right now. I think that actually, so Edgefinder seasonality is scoring incorrectly. So I'm going to get that sorted out. I just messaged the dev team. They must be working on something and might have score got mixed up or something. But yeah, seasonality actually being +2 would put us at a factor of 4. That's a +8. So gold should be at the top of the list, and it will be in just a second. Anyways, other thing that I wanted to mention about gold, and I've said this a lot of times on the show, but I just want to reiterate it. Look, gold is institutional money has been long for the whole ride. So the whole time with gold on this show, if I had $1 for every time I discussed how retail traders are all short gold and institutional money was long, I could just go retire on the beach for the next, lifetime. I say it all the time because it's really important that we get this. Look, the COT data history shows us long positions versus short positions of institutional money. Institutional money has been persistently long gold. So there's no reason, this in combination with weaker US economic data gives me every reason to stay bullish gold and no reason to get bearish gold. Institutional money is long. Economic data points towards bullishness for gold. Does that mean it's going to go up forever? No, it's going to pull back. It will eventually. It may not be today, may not be tomorrow, but it will. And so on those pullbacks, I'm going to be a buyer until conditions change. Okay. So tracking institutional money is really important for this matter, because if you looked at this for even a split second for the last 2 years, you'd say, oh man, I got to be real careful about sells, because look who I'm fighting against. Smart money. Smart money's been bullish gold. Okay. Initial push slightly higher for NAS, for gold, dollar index, still waiting on the data. Okay, there it is. Manufacturing PMI coming in soft here today, guys. 49. Dollar index slightly lower off that. What about JOLTS? Still pending on my side. Still waiting, at least on Forex Factory. Okay, there it is. Lower than expected JOLTS job openings and lower than expected manufacturing PMI. So some soft data points here this morning. Would not be surprised if we do see bonds reacting positively to this. Yep, there it goes. TLT up and away on this data. Again, yield's going to be dropping. Probably not a positive thing for the dollar index, but we're really not seeing too much of a move here. But yeah, we did get, again, like I said, softer than expected manufacturing PMI data and JOLTS job openings with minor revisions. I mean, that's a pretty soft day here in terms of economic data. 49 shows contraction in the manufacturing part of the economy. There's the dollar index on a 30-minute chart, 1 hour chart, mostly unmoved. Not too much of a spike in either direction. Stocks are modestly lower off of that, but really not a huge move there either. Here's your 1 hour chart. If it will load, there it is. You can see 1 hour chart pretty unchanged for NASDAQ. Huge slide here recently. Bounced back a little bit towards the second half of the day yesterday, but still just it's been a rough couple weeks for markets here. Internet went out on my PC, but not on other devices. Sorry to hear that, Alan. That's frustrating. We're going lower with that data. It's definitely not a positive point, right? Definitely not what you really wanted to see out of JOLTS job openings. What people I think were looking for on the stock market side for like a strength, for durability, we'd want to see this number come in higher, right? Manufacturing PMIs, same thing. We want that number to be higher than expected. So we actually are getting the opposite, right? We're getting some softness there. I would argue mostly a bearish thing for the dollar index and a bearish thing also for stocks. Stocks, I think, there's this ongoing debate. Some people are more thinking that the Fed is going to fixate on inflation, and others are wondering if they're going to focus more on growth. Growth pertains to jobs, PMIs, consumer spending, the state of the consumer. Inflation is obviously prices rising. There's a good argument you could make that the Fed's going to focus on either, right? There's a good argument you could make for both sides. I'm curious, what do you guys think? Any fundamentalists in the room? I'm asking you guys for some help on this. Okay, Fed has got problems with inflation staying sticky and signs that growth may be starting to weaken. Jobs data, the consumer pulling back on their spending, GDP growth expectations lowering, inflation, right? CPI, PPI, PCE, these numbers going higher, showing prices are problematic. I want to ask you guys, which do you think the Fed is more focused on? Inflation or growth? That's kind of a trick question because the Fed focuses on both, right? They have a dual mandate. But I'm curious, what do you guys think is more important to the Fed? Is inflation a bigger problem or growth a bigger problem? What do you guys think? Growth, inflation, jobs, growth, inflation. Can't focus on growth with tariffs, inflation, growth, inflation. We've been through inflation. And this right here, guys, this right here is a very important point that I want to make. Does anybody not have some PTSD from inflation in the past few years? I think we all had a little sticker shock, right? I don't know about you guys, but I remember, I'll never forget this the rest of my life. And I bet a lot of you guys are the same way. I'm fortunate to not be, at a point in my life paycheck to paycheck, but there's a lot of people who are. And even as somebody who is not, I still remember going to the grocery store and being like, oh my gosh, everything just went up in price. Like literally 2 weeks ago, I went to the grocery store and I spent, $70, and now I'm spending $81, right? Something like that. Like that materially, you feel that. I think everybody has a little PTSD from inflation. And that's in the United States where we did have inflation, but God forbid if you're in other places that got it much worse than the US, right? At least the US has the global reserve currency. We can print the currency and use it first before it gets exported to everywhere else. We saw inflation like 10% for the UK. Those were dangerous levels of inflation. So the Fed and everybody else has a little PTSD about inflation. But people forget 2008 was also very ugly. When people lose their jobs dramatically, that can send everything into a horrible spiral. The Fed's in a tough spot.
Boxes lifted in their sectors. Let's go currencies, and I'll let you go for today. Aussie CAD, still like long, still like leveling in. Aussie Swiss, same thing, still like long, still like leveling in. Watching that flash crash low from August 2024. Aussie Yen, watch the flash crash low if we're going to build support. That's a pretty good way to do it. Aussie New Zealand. I'm still long in this trade. I don't know if this is, this is my target. I'm long with a channel here, right? So long with the channel here and looking to see if we just go back up towards, 1390. Realistically, I might just take this trade off. If we come back up to these highs, I might just dump the trade or at the very least move a stop loss. But I'm looking to see if this channel will still hold and we get to higher highs. So that's why I'm holding long. Otherwise, it's just a big range trade. Aussie CAD, New Zealand CAD, Aussie, New Zealand. I could range trade those things forever and never really worry about direction. Just trade the inefficiencies, trade the pivots, trade ranges, and they usually are pretty responsible. Aussie dollar, nothing on this yet, but I would look at a pending buy again if it was offered up around like these lows. I'd look at an Aussie dollar buy trade again, or I've got this buy limit down here at 6,000. CAD Swiss, I'm still holding long. Looking to see if we can stack these babies up all the way to about 64.90. CAD Yen, right off the equal lows from August. Swiss Yen, no trade. Euro Aussie, be careful on the Euro Aussie, Euro CAD, Euro New Zealand. There's just a lot of aggressive movement. You've got to get your higher time frame structure with your lower time frame precision. You've got a sharp turn on the day. It's just hard to trade like a straight up candle followed by a straight down candle. It's very hard to trade that unless you know where this high is at, and it still didn't test it, right? It didn't test the highs. So anyway, somebody's asking why is Bitcoin jumping? I don't know. The markets are up. So we've got 55, 58 in the S&P. The S&P's up 70 points from the lows today. There could be just some flows. I'll go back to Euro Aussie in a second. I wouldn't say this is jumping. I'm just saying like it's green. But Bitcoin doesn't look exciting to me until we're above these highs or we're coiling into a better price. So, I wouldn't get overly excited unless we're on the right-hand side of this trend line to say that the bulls can clearly see there's permission to then go up. Why is the market up today? Like I said, this could be the bear trap scenario. Look, this whole idea of global recession is, I think, a little overblown, right? Prices can lead there. Like, I get it that it's all connected. So if the S&P rolls over and we start cracking these 5,500 lows and we start getting down to this terrible bearish territory, then Wall Street could feel it first, price action feels it first, and then all of a sudden it's like, there's momentum both ways, right? A job gained could be followed by another job gain, and that sentiment and that trend continues. But job loss follows another job loss, and all of a sudden it's a perpetual cycle. So market's up today. I think it just shows like the levels were defended yesterday. There's maybe some drift and recovery, and this could be another opportunity to kind of de-risk just a little bit. But I'm not a perma anything. I'm not perma bull. I'm not perma bear. I think this is a spot to be just not doing anything brave or stupid. Just trade small, take good trades, define risk, and be patient. If I'm going to get way more bullish, it's going to be way the heck down here. I'm not way bullish now. I think taking some bites here is understandable, but that's about it. There's too much noise around this 200 moving average for this market to be indecisive. And it's like the bears can take control, the bulls can take control. I don't know which one's going to do it. Okay. All right. Let me go back to currencies. Euro Aussie, Euro CAD. So, I mean, it looks like we're getting a decent commodity move, meaning like I could see this heading back down into some type of corrective level. So, maybe getting a little nod from Aussie, CAD, New Zealand getting a little bit stronger here. Euro CAD, same thing. Euro Swiss, fine. Euro Pound, no trade. Euro Yen, Euro New Zealand. Yeah, I mean, if it holds this level, I mean, Euro New Zealand getting back to lows or just a pullback zone. There's previous resistance here. Could be a little, again, if you're following on a smaller time frame, could be a little 1-to-1 or slightly greater. Just got to be in those smaller time frames for some precision. Still leveling into Euro Dollar. Let's see what happens there. Pound Aussie. This could be a pretty good fade. I like this one potentially as I want to see this channel break though. Like this isn't perfect, but if we break the channel, returning into like previous highs or some type of pullback zone. Pound CAD. Just some type of balance, right? Here's your low, here's your high. If the market heads down, we're just finding some equilibrium somewhere here on the pound CAD. Pound Swiss, nothing. Pound Yen, nothing. Pound New Zealand. I don't like it as much as Pound Aussie, Pound CAD look a little bit cleaner. Pound Dollar, no trade. New Zealand CAD is still like leveling in on my big lows. Buying lows, buying lows, buying lows. Stay in the range. Big range from 76 to 88. That's a 1,200 pip range. I would trade that all day. New Zealand Swiss, leveling in. New Zealand Yen, off the lows. Be careful on that one, as of course, stop area below these lows. New Zealand Dollar. Watching closely. I mean, maybe a revisit of these lows. 5,600 down to 5,500, maybe not a bad spot. I'm going to delete these levels since I closed out those trades. So yeah, if we get to 56 or 55, I'll probably take some bites again. Maybe looking to go long New Zealand Dollar. Dollar CAD, no thank you. I don't know what this thing wants to do. This whole idea of like US and Canada becoming more like adversarial instead of friendly neighbors could make for an interesting dollar CAD position later this year. I just don't know where we're going to go. Yeah, I mean, I see this as resistance. This little shenanigans that the market played with that big gap over the weekend. That could be a topping pattern where if oil rallies, then sure, the CAD gets the upper hand for right now. I just wouldn't be super I wouldn't be long-term bearish on this. I could see us going back to like 3,900, 3,800, but that's a halfway point, right? So could we go further and go all the way back down to 32? Maybe. But I would say if you're lucky right now, the swing is this type of swing. Playing it down to like 4,000, 3,900, getting out, taking your profit, and then see what's next. Because if this level bounces, resistance becomes support, you can take this right back up to the highs. But I'm sure there's a lot of traders that are positioned for this right now, but short dollar CAD, stop loss above the swing high, and hoping there's some follow through. Right? Dollar Swiss. I wouldn't mind it hitting 92.50 or 92.05 again, or 9200 again. If it pulls back, that's fine. I'm just going to hang in there. Dollar Yen, no trade yet. And that's kind of it. So, all right, covered a lot. Gold, silver, dollar, all the currency pairs, stocks, where are we at for the indexes, watching things. Trump, tariff talk tomorrow. We're actually green on the day, so SPX up 0.44. Q's, NASDAQ up about 0.7.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.